Good evening. I am going to be in Dubai in the last week of February. My team wants to do an event between 24th and 25th of February. There are going to be two events, one on the 24th and one on 25th. Those desirous of attend the event, not only from Dubai, Abu Dhabi and Sharjah, but from the rest of Emirates, can contact my team at the phone number given below. The WhatsApp number is also given below. There's an email ID and there's a Google form. You can use any of these methods to connect us, and my team would be glad to help you. See you in Dubai.
Hi everyone, welcome back to Be Rich. Everyone's been asking me about Zydus Life, and about the stock buyback. So I thought I'll talk about stock buyback and what is the Zydus stock buyback about, and what you should do. By the end of the video, I'm sure you'll understand what it is, and then you can decide what you want to do. Zydus Life was first known previously in its previous avatar as Cadila Healthcare, and was a prominent player in global pharmaceutical company. Okay, it has a strong presence in the US too, right? It was started in 1952 in Gujarat, Ahmedabad, and it has over decades of experience doing this. They do R&D, they have a huge product portfolio, and they're a good company. And they have a lot of innovation and things in their pipeline. And everything about the company is great. And it's a company we've been looking at for quite a long time. And right now, the share price it's trading at is 805 with a PE ratio of 24.9, which is on the slightly higher side of things. And the company is almost debt free, which has always been the biggest plus point about this company. So, what broke the news? The news broke a couple of days back that Zydus has announced a share buyback. It has approved, the board has approved a 600 crore share buyback at a premium of 1,005 rupees per share, which is a 25% premium over the closing price before the announcement. Since the announcement was made, the price has moved even further. It was at around 760, 790, and it's gone now pushed past to 800. So it's moving towards that band of closing to 1,000. The buyback is supposed to represent less than 0.6% of the total paid up equity capital. So they're buying around 0.6% of the shares. And the route they're using is known as the tender offer route. Okay, before I get into the different routes, I thought I'll finish telling you about the record date and eligibility. The record date and the eligibility to participate in this share buyback has been set as Feb 23rd. So if you own a Zydus share before the 23rd of Feb, it's there in your book. You can participate in this. The US arm has reported $221 million in terms of sales, and it's slightly lower than the estimate, but it's increased year on year, and the profitability has also soared by 26.8% from the last year. So profitability is good. They're doing very well in the US. Not met what the analysts had expected, but it's done well. Now, in India, there's two ways a company can do share buybacks. One is known as a tender offer, and the other is known as the open market buyback. Recently, I think it was Bajaj or one of the other ones which was announcing was through the open market buyback. So I thought I'll briefly explain to you, since most of you are new investors, how buyback works, and the Zydus buyback is going through the tender offer. Before I get into the tender offer, I'll talk about the open market. In the open market purchase, what happens is the company buys a share back at the current market price, which can fluctuate during the buyback period. So they set a ceiling, right? It's known as a price ceiling, which is the price they will not pay anything. While there's no fixed price back, the company often says a maximum price they're willing to pay per share. So to ensure they don't overpay. Because if you don't have a price ceiling, everybody will be running and trying to pick the share, and the amount of shares in the market will drop and pushing the share price even higher, and thus kind of defeating the purpose of the buyback. So, and the duration also is set. The company will say we'll buy back within a fixed period of time. That duration is set. Then volume limitations also are set. Regulators will often limit the volume of shares the company can be bought at a given day to prevent market manipulation. So in a day, they'll say, so many shares can be bought. So this is to prevent, price fluctuation, market fluctuation. And what are the benefits? This method allows the companies to be more strategic and flexible in their buyback process, taking advantage of market conditions and buying back shares at a favorable price. So though they have a ceiling on the top, there's no ceiling at the bottom. There's no floor, as they call it. Ceilings on the top floor. Below, there is no floor. And as the price goes lower, it is more beneficial for the company. Of course, there are limitations, volume limitations. So these are things in the open market buyouts. Now, what is the tender route? Tender route is company announces buyback details, including number of shares they intend to buy back and the buyback price and the time frame during which this will occur. The buyback will occur. The price here is fixed. It's not a variable price like the other one has. The price is fixed. The buyback price is usually set above the current market price. So incentivize shareholders to sell their shares back to the company. Because let's say their buyback price is at market price or below market price. Why as a shareholder will you sell it? Rather hold on to it. The company wants to extinguish those shares. So they always offer a premium. And the premium this time, what they offered was 25% more. And the stock price has already started moving towards that price. Then the record date is set, which means the date when you're eligible as a shareholder to participate. So you cannot keep on saying, I buy the share today and then I'll participate. No, you can't do that. They set a record date. So this keeps it very clear. The date when you have to be owning the share to participate. Then this is the critical thing, which is known as tendering the shares. The tendering the shares, what happens is the shareholder through the brokers will submit a buyback form. Okay, where they'll electronically submit it to their broker and they'll submit the form saying, these are the shares I'm offering from my side to the buyback. So here is the key thing. There's an acceptance ratio, okay, which we do not know in the case of Zydus as yet. The board has only approved 600 crores. They have approved the price. So you can do the simple math, which I'm not going to do for you. You can divide the 600 crores by 1,005 and you'll know the amount of shares they're going to buy back. And the acceptance ratio, we do not know as yet. Acceptance ratio is depending on the response. The company may not buy back all the tendered shares. So let's say they offer the tender and they want to only extinguish 1,000 shares. Then they have 5,000 shares have come through the tender process. So that means they can't take all 5,000 back. So if it is below 1,000, then they can take it, not an issue. So the acceptance ratio determines how many shares from each shareholder will be brought back. So if the buyback is oversubscribed, the company buyback may appropriate number of shares to each shareholder. So here also there's a subscription. So everyone submits electronically the form. Let's say too many people have oversubscribed to the buyback. Everyone wants to turn in a lot of shares to the company. They feel the price. The reason why this could happen is the premium offered is so great. The shareholder feels to reach that price point, the company might take anywhere between 2 to 3 years, right, to grow that 25%. So I don't want to wait for that. I'll throw in my shares, collect the premium, then the price will correct because post the buyback window, prices again will correct, will go down. At the time, I can buy these shares back at a lower price and I could have made a handsome profit. This is a strategy. I hope you understand the strategy behind what buyback is. So this is the main thing which people are trying to do. So in the case of Zydus, we know 600 crores, we know 1,005 rupees is what has been offered. The acceptance ratio, we still do not know. And the cutoff date has been also set. So the next couple of days, probably by the time you're watching this video, we'll know more information. As we gather more information, I'll be happy to share with you. And in the comments down below, you can also share the more information as you find them. What is the key difference between open market and tender is? There's a price thing. Tender offers an involved fixed price, often at a premium, while the open market is conducted while prevailing market conditions at a maximum price limit. Flexibility. Open market offers flexibility in timing and in pricing, while tender offers a limited but a fixed time frame and a price. Third thing is the shareholder's decision. In the tender offer, the shareholder must actively decide to participate and tender their shares, whereas in the open market, there's no action that is required from the shareholder other than selling it. So understanding this will help you. And this is a tender method which they're going through. So keep this in mind. Zydus is a great company. It's trading at slightly higher than fair price. That's my opinion. So do keep all this in mind if you are planning to get into this tender process and participate in this buyback. If you are, I wish you the best of luck. One key thing which I want you to keep in mind is you will see in the media somewhere it's being mentioned that acceptance ratio is around 2%. That means for every 100 for retail investors, 2 will be looked at as an acceptance. For every 100 shares you offer, they'll take 2. But my personal experience in buyback, which I've participated in the past, has been is pretty much like IPO. Sometimes the role of luck plays into this because of this, the way this oversubscription goes. So even sometimes, let's say in the rule, if it's 2%, you have to offer 100 shares, they'll take 2. Sometimes I've offered less than that and I've been accepted 2. Sometimes in companies which has had an 25% acceptance ratio, I've only offered 1 share and it was gone through. and sometimes none went through. So some of it is luck. Do keep this in mind. Acceptance ratio is a metric, but it doesn't mean you will get a guarantee of a buyback. So if every 100 shares you offer 2 shares, if it says acceptance ratio 2%, it doesn't mean for every 100 shares 2 will be definitely taken. It also depends on the subscription amount. So keep that in mind. Thanks for watching the video, guys, and I'll see you in the next one.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.